Well, it may provide opportunity for you. So on that note, we're going to bring in our all-star markets panel. Gary Kaltbaum, Jason Rotman, Steve Moore with me now telling you how to play this selling. Glad to have you all joining me. Jason, I'm going to start with you. I have to pick Apple. This is the most owned stock in America. It has wiped out something like $160 billion as far as market cap goes from its highs in February. Should investors consider buying?
Yes, I think briefly the answer is a solid yes. I mean, listen, you want to buy when there's panic, okay? As the saying goes, when there's blood on the streets, then you jump in. At this point, with all the major stock indices down, with Apple getting crushed, listen, Apple's not going anywhere. They have hundreds of billions of dollars of cash. They can buy companies. They're crushing the iPhone or the cell phone market. The game, the story's not over with Apple. It's a short-term correction. Don't panic. That's my message.
Don't panic. Gary, do you agree?
Sorry, I'm going to disagree. Apple is in a bear market. They cannot continue to outdo what they have done. It's still a great company, but iPhone sales will not be as much next year as they were this year, and I suspect the stock's got a good another 20% at least before I'd even consider looking at it.
Okay, I want to go a little bit more macro because we have a look at maybe a free fall for oil prices. I mean, crude is down for the second year in a row, and for context, it's the first back-to-back losing year, or years in this case, for oil since 1997 and 1998. Steve, I want to ask you, what do you make of these declines in energy prices? I was just talking with my colleague Ashley Webster saying at the gas pump, it's great, but then at what point from a macro level do we begin to say, this means energy companies are going to cut jobs, and this means deflation is a risk?
Ashley, as you know from your Economics 100 courses, the price of something is a function of the supply and the demand, and Ashley touched on this. We've got right now record amounts of oil being produced because of the shale oil and gas revolution, really driven by American ingenuity, and that's, flushed huge amounts of new oil production onto the market at the same time that OPEC, as Ashley said, it continues to churn out its oil. So that's a positive thing. Look, when things go down in price because the production goes up, that's good for everybody else. But there is, as Ashley pointed out, there's a supply side shift here, too, where the rest of the world looks like they're in a mini or a wholesale recession right now, and they're not, if you're not producing things, you're not buying a lot of energy. And so you have to balance these two things. Look, if oil goes to $20 a barrel, that's going to have a devastating impact on American oil and gas producers. Many of them, if not most of them, just can't make money with the price that low. But one other thing that happened this week, Deirdre, just to round out this story, is in the midst of this terrible news for the oil and gas industry, they did have some good news this week, which was the lifting of the export ban, which will help somewhat these distressed oil companies here in the United States.
Yeah, that's a great point, because this is the first time in 40 years, 4 decades, that the U.S. can actually export oil. Although at these prices, I'm not sure how much we're going to make, but that's a separate issue altogether. I want to ask you, Gary, about the energy sector, another branch of it, natural gas, which of course is very linked to what we're discussing here. Concerned or not about deflation?
I am big-time concerned. Look, it's not just oil, it's not natural gas, it's also tin, copper, aluminum, steel, you name it, it is everything. And the worry is simple, that all other asset prices are going to follow suit, that what the commodities have done, and that is not out of the question. That means stock market, that means real estate, that means art, and all these other things that have been bubbled up because of central bank intervention over the last 7 years. I have been worried about bubbles. I think we're hitting an inflection point here, and that's why I think we're going to have a bear market in stocks as we head into 2016 as markets catch up with all this deflation and all these other areas. And it is about demand. I do believe markets are saying that we're going to have a real gigantic slowdown across the globe, and if not, the recession.
Okay, Gary, I just want to underline what you said, because that is the whole point. That is to say, it's one thing to see a sell-off in a particular asset class. We're talking about energy, but then when it starts to leak out into other categories, you mentioned stocks will be next, then that is a very big red flag.
I do want to mention one other thing. with oil prices crashing, so are the transport stocks. Those are the companies that should be benefiting big time, especially the airlines, and they're going down. If that doesn't tell you anything about the economy, I don't know what does. And therein lies my big worries. I believe markets are a lot smarter than anybody else's opinion.
Jason, you are usually a bull. You are usually optimistic. What is your take?
Well, you know what? Listen, the bottom line is that this is a initial, I would even say knee-jerk reaction to a very, very hawkish Fed statement. I think much more hawkish, you know, after 24 hours of analysis than anybody was even expecting, okay? So the selling is to be expected in that view. Now, in the bigger picture view, I'd like to focus on something that hasn't really been brought up yet, is China, okay? China, even though they have technically not a huge correlation with U.S. markets, for some reason, when China sneezes, the world, you know, takes heed. China's interest rates are still 4+%. I think China, if they're going to start to lower interest rates multiple times next year, that will be a massive support to the global stock markets. I really believe that.
All right, leaving us a little bit of a silver lining, but I want to get back to this fear factor because it did show up somewhere else. Fear showing up in the price of gold. I mean, gold hit a 3-month high. So I want to ask you, Gary, how high do you think gold can go?
Look, if the market keeps going down, I think gold is most definitely going higher. But overall, the big picture in gold right now still remains in a bear market also. It has not changed the big trend that's been going on for a few years. So I would suggest it would be just a good tradable bounce if the markets keep going lower. But I don't think long-term on it. And I must tell you, with all the money printing, I would have thought gold would have been 5,000 by now. So I'm a little bit confused by it. But I'm a big believer in price, and price is not dictating to me anything great in gold right now.
Look, Deirdre, if we think that there's deflation out there, and I'm not quite as sold on that as the others, but if deflation is happening, then you would see that in the price of gold, right? I mean, gold would fall as a commodity as everything else has. And we just had an increase in the interest rates the Fed is charging. You would have thought that would actually pull back on gold. So it's a very perplexing picture. I mean, I'm one of those people who predicted that gold was going to go to 2,000 a number of years ago, and you know, it stuck at 1,200. But I just don't see a rising gold price consistent with the deflation picture. I don't see how you can square that circle.
All right, we are glad to have you. Glad to have your thoughts. Steve Moore, Jason Rotman, and Gary Kaltbaum, thank you one and all. We do have